For most people, a low interest rate is one of the key factors in choosing a home loan. But is it the only factor you should be thinking about? Hey everyone, it's Kim Quach from DuoTax, here with another video designed to help you become a smarter property investor. When you're shopping for a home loan, there's no doubt that it's important to compare interest rates. A lower interest rate will mean lower monthly repayments and potentially thousands of dollars in savings over the life of the loan. For example, on a $500,000 loan, just a 0.5% difference can save you almost $50,000 in interest over the life of the loan. But interest rates are just one part of the equation. You'll also need to consider quite a few factors, like the term of the loan, the size of your deposit, and any extra fees that may be attached to the loan. All of these things, plus a host of other factors, contribute how much you end up paying at the end of the day. And so it should be something you consider before you select a home loan package. We always recommend that you get the help of a mortgage broker, because it's their job to find you the best home loan for your circumstance. But to help you understand the basics, we're going to run through a few things you should add to your list of considerations when finding your next mortgage. Before we do that, we want to be clear that this video is for informational purposes only. In no way should you interpret this as financial or tax advice. We always recommend working with a qualified financial advisor or tax agent to give you the best advice for your situation. Let's get started with the types of interest rate. A home loan's interest rate will either be a variable rate that moves up or down, or a fixed rate that stays the same during the loan term. If you choose a variable rate loan, your interest rates may change at any time in line with the changes in the economy and lending market. This type of loan usually offers the greatest amount of flexibility when it comes to making extra repayments or switching loans. But you'll need to be prepared for your repayments to increase if the interest rate goes up. For example, the Reserve Bank of Australia has recently hiked the interest rate by 0.5% each month for a few consecutive months, which means lenders have to. And those with variable interest rates have had to start paying higher monthly repayments. In most cases, if you go for this option, this means that you'd be approved with a built-in buffer in case the interest rate rises. On the other hand, the interest on a fixed rate loan will stay the same for a set period of time, usually between 1 and 5 years. On the plus side, this can be easier for budgeting purposes as your repayments will stay the same. Unfortunately, they're not always as flexible as variable rate loans. There are generally restrictions on making extra loan repayments or switching your loan during the fixed rate period. And you'll miss out on any benefits if interest rates go down. Last year, for example, the interest rate hit a record low of 0.1%. So those on the fixed rate would have missed out. With the recent interest rate increases, fixed rate borrowers are locked in and aren't having to pay higher monthly payments. So there's pros and cons to both types, which will inevitably impact how much you pay over the life of your mortgage. The next thing you need to consider are fees and charges. Along with interest rates, a number of fees and charges can also contribute to the total cost of your loan. These include monthly or annual fees, establishment fees, valuation fees, exit or break costs, redraw fees, and lender's mortgage insurance. Lender's mortgage insurance, or LMI, is a type of insurance premium that lenders charge to protect themselves if you're borrowing more than 80% of the value of your property. Depending on the size of your loan, this could be quite a big extra expense, especially if you add it onto your home loan. There's definitely something you need to factor in. Mortgage brokers will generally consider this and work with you to help you understand the impacts of any fees and charges on the overall costs of your loan. Earlier, we mentioned that with variable interest rate loans, you have access to extra facilities like offset accounts and redraw facilities. An offset account is an everyday bank account that's linked to your home loan. You can deposit your salary and savings into the account, and the balance is then offset against the amount owing on your home loan. So let's say you have a home loan of $250,000 and $30,000 in your offset account. In this situation, you'll only be charged interest on a loan balance of $220,000. Because the offset account acts like an everyday account, your $30,000 is still accessible whenever you need it, even while it's working to reduce your overall interest repayment. A redraw facility, on the other hand, lets you access any extra repayments you've made on your home loan. This also essentially allows you to reduce the interest on your home loan. Extra features like the offset account and redraw facility often come as an additional cost. Can also be beneficial in the long run if used to your advantage. So, this is another consideration that can impact the overall cost of your mortgage. And then lastly, the lender you choose will also make a massive difference in terms of securing the loan, the extra features available, and the interest rate you get offered. For example, different lenders will define income in quite a few different ways. One lender may allow shared dividends as income, while another lender may not. And factors such as your credit history, financial records, length of time in your current job, and the amount you wish to borrow can all have an impact on which options are available. It's important to consider more than one lender when on the hunt for the best mortgage. Again, this is where a mortgage broker comes in handy because they have access to a whole network of lenders, which allows them a much broader list of options when it comes to choosing something that's going to fit your circumstances perfectly. As you can see, the best home loan isn't necessarily about the best interest rate. There is an array of things that will label a home loan the best. And ultimately, it comes down to your personal situation. You need a product that's going to work best for you. I hope you found this video useful as you begin your home buying journey. But if you have any other questions, you're welcome to leave them in the comment section below. Otherwise, that's it from me on this topic. Remember to get in touch with a mortgage broker. Oh, and if you would like access to more property buying insights, make sure to like and subscribe. I'm Kim Quach from Duo Tax. See you next time.